Okay, and I think we will officially start. So, hello everyone. Lovely to see you all today in sunny in Edinburgh. I'm Jane. I'm in the membership team here at Social Enterprise Scotland with my colleague Amy, and we're hosting today's Introduction to Democratic Finance session. Thank you all for making the time to come along today. We know how busy everyone is. I'm really excited for today's session as this is a topic I'm definitely interested in learning more about, and I think one that's going to become increasingly important for the sector. So I guess, well, the simple plan today is we're going to have a presentation on democratic finance from Democratic Finance Scotland, and then we'll move into the discussion and Q&A. So we are delighted to be joined today by two fantastic speakers from Democratic Finance Scotland. We have Julia Rolim and Morven Lyon here with us today. I'm just going to hand over to you both. You can take it from here. All good?
Yeah, cool. So thanks for the introduction, Jane. I'm Julia. I'm a development officer in the Democratic Finance team, and my colleague Morven Lyon, who's the head of the program. So we're just gonna run through a little bit of an introduction to our program, the type of support we offer, I guess what we mean when we say democratic finance, the types of fundraising that we work with, and then we're gonna do a little bit of a deeper dive into our main fundraising methods, which are community shares and crowdfunding, talk a little bit about one of our pilot programs into local legacy giving, and some of the other alternative finance models that we're researching and developing at the moment, and a little bit on community energy, and then hopefully open up to you. A lot of information, but we will share these slides after, and feel free to ask questions either at the end or throughout. Okay, so I'll start us off with a simple introduction to democratic finance. So what is democratic finance? So for us, it's a program of support for community-led organizations looking to explore alternative methods of raising finance. So the sort of core principles we see of democratic finance are that the community has financial control and that democratic power is embedded into the organization. So that communities can use these methods to take ownership of important community assets and run democratic community businesses. So what do we mean by alternative methods of fundraising? So the main alternative methods that we work with are community shares, income from renewable energy developments, either 100% community owned renewable energy or shared ownership, and donation or reward-based crowdfunding. So we'll go into these methods in more detail a little bit later. And then the other areas of support that we're currently researching or piloting are community bond offers, local legacy giving, local philanthropy, one-off community lotteries, and common good funds. So how does our support sort of work? We are fully funded by the Scottish government. So our support is free. So it's free for all communities that are eligible. And it sort of works in two stages. So in the early stage, we sort of reach out to communities or have communities reach out to us and discuss what democratic finance sources are the best fit for your organization or for your project. And then if we find a good fit, we work in more in-depth development. So this will usually be one-to-one support around community engagement, community consultation, governance support, business planning, and sort of financial modeling. We work with a lot of partners in the sector as well, so we refer to specific partners for different projects. Okay, so who's eligible for our support? So we work with any community body that has, or if they're unincorporated or in very early stages, they have a desire to adopt a democratic and accessible governance structure. So by this, we usually mean it's a member-led organization. It's a two-tier structure, and there's very clear sort of member control of the organization and democratic processes. So an enterprising, empowering, and sustainable approach. So for this, it's a focus on income generation and trading, and enterprising activity is at the core of the organization. And Morven will go into this a little bit later, but that's particularly important for community shares, because there's a repayable element there to that sort of fundraising. So it's really important that trading and enterprising is at the core of the organization. And also a grassroots focus on securing, boosting, and retaining local wealth. So this is maybe where we differ a little bit to more traditional social enterprise support. The organizations we work with have a very local element, so a place-based regeneration remit to their activity. So why is democratic finance needed? Why is it an important way to diversify your fundraising? I mean, as you all know, like grant dependency in the sector is really high. So any sort of diversification is super useful for any community group. We work with a lot of communities where social investment loans are not always affordable and are not always the best fit for their projects. So alternative methods of fundraising offer like a more affordable way to raise money. Match funding is often required. So a lot of groups we work with have secured grants either through like SLF or a national lottery, but they just need that final amount of match funding to do their projects. And often this match funding needs to be sort of flexible, non-capital funding. So that's where all these like very flexible options like shares and crowdfunding are really useful. And we really believe it builds democratic and robust businesses. So on that last point, we did some research last year into the past 10 years of community shares. So the Democratic Finance Program has been going on for about 10 to 12 years. And we did an overview of all the community shares that we've supported. And one of the key findings of that was that a business that's done a community share offer has a 95% survival rate, which is a really high and impressive stat. I think compared to the private sector businesses, it's about a 60% survival rate. So we really believe in this method of like building a democratic buy-in and a sense of ownership from the community builds a really robust business. It really improved the community confidence to deliver big projects. Communities often went on to deliver other projects. It can attract further funding and partnerships. It's really, really important for job creation. So from the community share offers that we supported, there were 208 jobs created that would have otherwise been lost. And it's a really, really flexible form of financing. So yes, it's repayable and interest, but interest and withdrawals don't necessarily have to be paid annually, and they can kick in after a couple years. And that's where it really differs to more traditional forms of loan financing. But I'll pass on to Morven now to go a little bit more in depth about community shares and crowdfunding.
Thanks so much, Julia. Hi, folks. Thanks for having us along today. I'm going to do a slightly deeper dive into community shares and crowdfunding, but the key message being that if you want to know more or get more support from us, then please just reach out. DTAS has been delivering community share support for 11 or 12 years. So just a kind of way of introducing it is that it is crowdfunding is probably the easiest way of describing it. So you're going out to your community and you're asking them to invest into your community enterprise. Where community shares differ from more traditional crowdfunding is it isn't just a donation. So you're not just asking people to put their money in as a donation, it is an investment. So as Julia said, with community shares, the idea is that in the future, and it might be 5 years, 10 years, 20 years, the hope is that you will be able to repay your community members back. So that's the key distinction between community shares and what we would call more sort of donation-based crowdfunding. It's an investment model. The other really cool thing about community shares is that it has a kind of ownership, community ownership baked into it. So when someone invests in your business via community shares, and that can be from as little as £10, it doesn't have to be big bucks, they become a member of your organisation and a co-owner. So as Julia was describing, it really creates resilient business models because your investors, your shareholders are also members and co-owners of the business. Yeah, we have supported, I think, 70 organisations now to do a community share offer, raising collectively about £22 million. So it's a fairly well-established model in Scotland, and it can be used to finance a whole host of sectors. So we've listed some there. And if I think about the ones that we're supporting at the moment, so we've got a rural community shop, we've got an urban community cafe, we've got a couple of church buildings where the community have taken on the acquisition of the church building and then they're looking at an enterprising use within the building. We've also got a big community solar project. So as long as there's the community and the enterprising side of things, then community shares are a really good option to finance a project. Next slide, please, Julia. Thank you. So a couple of technical points, because I think it is important to note that in order to issue community shares, your organisation must be a community benefit society or a cooperative society. If this is something that you do want to consider as an option, then that is, we would help you through that whole process. So whether that is converting your current legal structure into a community benefit society, or setting up, say, a community benefit society to work alongside your current organisation, almost like a trading subsidiary, we can guide you through that whole process. Community benefit societies 10 years ago weren't very prevalent in Scotland, but we're seeing many groups nowadays use it. And it's a really great model for member control, community enterprise, and to access grant funding. It's registered with the Financial Conduct Authority, not regulated by, key distinction, so registered with the Financial Conduct Authority instead of Companies House. You can get a charitable community benefit society. So just in the same way that any other organisation would, you apply to OSCAR for charitable status. It's always two-tier, so it's always membership-led, and then those members elect the board of directors. It's asset-locked, so there's no private gain here. This is about wide community benefit rather than individual private gain. And then a key thing that I think is important is the concept of one member, one vote. So say I purchase a community share and become a member for £10, and my neighbour purchases 100 community shares. So they've put in £1,000. They don't get 100 more votes than I do. So it's one member, one vote rather than one share, one vote, which is obviously very different to your private commercial company setup. Next slide, please, Julia. So just to give you a little case study to bring this to life a bit. So this was a group that we worked with last year. So this is Action 40, based just outside Edinburgh in Portobello. So this is one of the church projects I mentioned earlier, where the community take on acquisition of a church building and then develop a sort of enterprising business model inside of it. This group had actually taken on the acquisition of the church years ago, but they were entering the next phase of development to update their main celebration hall, so they could use it for wider community use. So this was part of a big fundraising effort where they'd got money from the Community Ownership Fund, from a local family trust. So the community shares element was that match funding that was needed. They managed to raise £168,000 through community shares, and that was from over 1,100 shareholders, all of those shareholders becoming members of Action 40. I've worked on many community share offers, but this one in particular really stood out in terms of their community engagement campaign and how creative it was and how they reached almost every corner of their community, it seemed. And not only individuals, but engaging local businesses as well, who were able to invest in the share offer too. Just some of the detail, because I think it's quite interesting. So they often, community share offers will have a minimum investment level. So for this one, it was £25, so one share of £25 for residents, so people that were local to Portobello. And for anyone outside of that community, they were able to invest, but it was two shares, so it was £50 minimum investment. And for them, it was really important that they retained local geographic control. So over 50% of the members have to come from Portobello. They got lots of investment from local organisations as well as local people. And then the kind of the financial side of things. So as we've said, community shares is a repayable type of finance. And what we mean by that is you often offer a little bit of interest on your community shares. So in this case, they were saying to their investors that they would offer 2% interest, and that they would also start to offer withdrawals. So that's where people get their money back from 2029. So it's quite good in that it gives organisations, often that kind of 4 or 5 year window to get going, to start trading before they have to think about paying back interest or withdrawals, which is slightly different to, say, traditional debt, a bank loan, a social investment loan, where often the interest payments and the repayment can start earlier than that. And I think I've highlighted those other points about it being a really enterprising business model, one member, one vote, and this amazing community engagement campaign. I think we've just popped a case study up on our website, actually, that highlights exactly what they did and some top tips. So I'll link to that in a sec. And then just to say on community shares that we will guide groups through this whole process. So we talk about the 4 pillars of community shares. So we'll help you do community engagement. We'll help you do your sort of business planning and financial modelling to make sure that the community shares element is inserted in appropriately. The governance, so setting up the Community Benefit Society, and then the share offer launch itself. So we take you through the whole process and the whole journey. And we also have a small marketing grant as well that we can offer for marketing costs during the campaign. Great, so just a couple of slides on crowdfunding support. If you can click on Julia, thank you. So historically, we haven't supported with donation-based crowdfunding, so it's quite new for us, and it's something that we're in the kind of early stages of exploring. But this is where you're going out to your community and you're essentially just asking them to donate their money in. So there's no repayment, there's no membership. It's a much more straightforward model. And we're seeing that it can be a good alternative to community shares or loans, or often it can work alongside a community share offer. You might do a crowdfunder earlier on in the process to kind of kickstart your project. All the data shows that if you do a community share offer, you tend to raise more money. So the average that our groups raise through community shares is normally around about 200,000, whereas with donation-based crowdfunding or reward-based crowdfunding, you're doing really well if you can raise, 50,000. So there can be quite a difference. And yeah, like I said, we're kind of testing the waters with what our support is on this front, but similar to community shares, we can help you plan your campaign, we can help you market that and engage the community. And again, we've got this kind of small micro grant available to help with campaign costs. And then the final thing to say on that is that we have just launched a crowdfunding guide that we've delivered in partnership with our community ownership colleagues at DTAS, who have a churches programme currently running for communities who want to explore buyout of church buildings. So again, we'll link to that. That's quite a practical step-by-step resource about how you would do a crowdfunding campaign. And then just before I hand back to Julia, I'll just give you a little case study of a group that we supported recently. So this was the Brig Inn. So they were doing a campaign to save their local pub, which you can see in the picture there. So they got Scottish Land Fund money to pay for, I think, 95% of the acquisition cost of the pub, but they needed that final little bit of match funding to take full ownership of it. So they did an amazing job. They managed to raise £40,000 through a donation-based crowdfunder in under 2 months. Really motivated, full of energy campaign. And how they have used the crowdfunder was to match fund the Scottish Land Fund grant and also to kickstart the campaign. And what they're now going to do in maybe 6 months' time is do a community share offer to help with all the refurbishment costs that are needed for potentially some initial stock, some initial staffing costs. So you can see how the kind of different fundraising models work quite nicely in a timeline. They use a crowdfunder platform, so they use crowdfunder.co.uk, and we can help you set up that page. And they use some really nice rewards and kind of prizes effectively for as part of their campaign. Is that me, Julia? Am I handing back to you now? So yeah, if either of those models work for you, or you think they might work for you, then please just reach out and we can explore what support we might be able to offer.
Thanks, Morven. Okay, I'm gonna talk a little bit about one of our other pilot projects, which is local legacy giving. But maybe does anyone have any sort of burning questions at this stage, or we can just save them to the end? Everyone's happy? Okay. Okay, so yeah, this is one of our sort of pilot programs, sort of an area that we're looking into. So legacy giving, what is legacy giving? So basically defines legacy giving is just when somebody leaves a gift in their will to a charity. So the gift can either be a nominal sum of money, say like 20K, or it can be an asset, a house, a piece of property, some land, or the percentage of an estate. So the gift can take many forms, and all sorts of people leave gifts to charities. So it can be a very small amount. It can be a sort of high net worth individual who's leaving a very large estate or a large property. So there's a huge range there. So a couple of years ago, I think 2 years ago, we started researching into the opportunity of legacy giving in Scotland. So we found that £90 million is given to charities and legacies every year, and legacy income to Scottish charities is actually growing at a rate of 7% per year. So growing more than other legacy markets. So England and Wales, there's about a 4.5% growth per year. So it's a huge sort of area of interest in Scotland. Around 500 Scottish charities benefit from legacy giving every year. 63% of those are small community-based charities, but about 10% of charities receive 70% of the legacy income in Scotland. So it's still a market dominated by large charities, national charities, and sort of the well-known names. So this is based on some research done by Remember a Charity, which is the national body for legacy giving in the UK. So they did a specific research into the legacy market in Scotland, and they found that Scottish people are very receptive to legacy giving. Around 42% of the people surveyed said they would be happy to leave a gift in their will to a charity, but in reality, only 6% actually do. So with this gap and with legacies being left mainly to large national charities, we decided to pilot a program of support to see if we could get smaller local charities or development trusts to tap into this legacy market. So our local legacy giving pilot program started about 2 years ago, and the first phase of the program ends in September 2026, so September of this year. So we were working mainly only with development trusts who are members of DTAS. So we worked with about 10 organizations in the first stage and supported them to increase their confidence in legacy giving. So this involved just some basic training around what legacy giving is, what the opportunity is, how to leave a gift in your will, how to help your community do that, how to explain legacy giving to your community. Seven of these organizations launched a legacy campaign. And then we also supported with workshops and referred to experts on legacy giving, developed some hands-on support to develop their legacy campaign materials, their legacy webpage. We offered a small micro grant to support with the campaign, so about £500. And all this was done in partnership with Remember Charities, so the national body that represents charities looking to do legacy giving in the UK. So there was a subsidized membership in Remember Charity for these pilot organizations. So for people who are interested, I've linked to a blog there, which is up on our website, that are learnings from the pilot program. But basically, to summarize the sort of learnings of this first stage, we found that there's a huge interest in legacy giving from these smaller, like place-based organizations, but often capacity is a huge issue. And with legacy giving, it's not an immediate source of fundraising. Like it's really useful as part of a larger strategy, but that money is not going to come through anytime soon. Like it's something that is for longevity. So a lot of organizations who are struggling to get money through the door immediately have a hard time sort of justifying the capacity they need to put into local legacy giving. But yeah, we found that the organizations that do get a page up and that do get some momentum found it really useful as part of a wider exercise in communicating the impact of their organization and getting the messaging right and speaking to their community. So it does have wider benefits. And yeah, we're going to continue to do some research around what support we can offer in this space and how we can get smaller organizations involved. So then some more of our models that we're researching and that are in development as well. So I'll just pass back to Morven for this.
Thanks, Julia. So yeah, I'll spend just 5-10 minutes going through some of the other models that we're developing as part of the program. So community bond offers is something that we have spent the past year in kind of research phase around what community bond offers are and what the kind of demand is in Scotland for community bond offers. So just to try and explain what a community bond offer is, it's very similar to a community share offer in that you're asking community members to invest into your community business. However, unlike community shares, where you have membership through the share offer, with community bonds, it's just a much more straightforward financial transaction with that community member, and they don't become a co-owner, they don't become a member of your organisation. It's a slightly stricter financial mechanism. So with shares, as we were describing, the interest payments and the withdrawals can be flexible. Whereas with community bond offers, what you would tend to see is that we are offering community bonds and say we have a fixed term of 10 years, we'll pay you back within 10 years and we'll offer 4% interest. It's quite an established model in England, we've realised. So we have done some research that shows, particularly in the community energy sector with community bond offers, that there's been quite a number of successful community bond offers for solar in England, where it's less established in Scotland. So this year we're going to be reaching out to DTAS members in the first instance, and then also the wider sector, to explore whether there is knowledge of community bonds and whether there is a desire to explore them more and a demand for the model, and how they sit alongside things like grants, community shares, crowdfunding and social investment as part of that gearing, we would call it, to make sure that organisations get the right type of finance. One interesting thing with community bonds we're exploring is, say, for community energy, where there is a need for a large amount of money to be raised. So we might have a solar project that's looking at £1 million. You might do a community share offer to offer local membership and local investment, because it's about that community buy-in and co-ownership, and then follow up with a community bond offer to raise additional finance perhaps as an alternative to a loan that might have a higher interest rate. And in that instance, you could offer that up, to a wider community, even nationally, perhaps. So that's quite an interesting model with community bonds and community energy. Common good funds. So these are funds that are held by local authorities that communities should have access to. And it should be a fairly straightforward process of applying to that local authority to access some of that funding. Often not a lot, we're talking kind of, a few thousand maybe might be a typical application you can make. Again, we've done some research and there's a huge variety of practice, shall we say, with local authorities about how transparent their common good funds are, what the process to apply is. So we're just about to produce a short resource that is going to outline what common good funds are, and potentially a bit of a kind of name and shame process of what local authorities are doing well and which ones could maybe be pushed to improve their transparency and their processes. And then the final thing is one-off community lotteries. So we know that a lot of community enterprises and social enterprises take part in regular sort of monthly community lotteries. And that's something that we're looking into as well. But what we're more interested in at the moment is the concept of running a one-off community lottery. So say you have an asset in your community that you want to purchase or a particular need for finance for starting up a community business. Could you do a one-off community lottery to very specifically raise money for that purpose in that moment in time? So again, like our legacy giving support, we're running a pilot program at the moment with DTAS members to look into this, and we'll be offering some kind of wider support in due course. And then final slide is on community energy. So maybe sort of skipping back to the beginning, as Julia was saying, the whole point of this programme is to give community organisations, so local place-based organisations, more democratic control and more financial power to do good stuff in their community. And looking at the bigger picture, the big opportunity for me at the moment in terms of how these organisations will get money in to do that is through community energy. And what we mean by that is where communities can install their own community energy initiatives. So solar farms, wind turbines, hydro projects, batteries, and through that get their own income. Or the model of shared ownership, which is where you've got a commercial development that goes up in your community, and the community are offered an ownership slice of that. Typically kind of 5 to 10% ownership of that local wind farm, and through that they get profits and revenue that they can spend locally on projects and services that they need. So there is a new programme of support that can help communities look into these ideas. It's called the Community Energy Launchpad, and it's a new CARES programme, so the Scottish Government Community and Renewable Energy Scheme, which is delivered by Local Energy Scotland. So this new Launchpad is one-to-one support for any community that wants to explore these ideas at an early stage. So whether that's the 100% model, the shared ownership model, or whether it's just as simple as greening your community building, putting heat pumps, solar panels on your community facility. It's delivered by ourselves, so DTAS and Community Energy Scotland. So that's who you would get the support from. And yeah, there's lots of workshops, events, one-to-one support available. So if community energy is something that you want to explore, then get in touch via the Launchpad. The link is at the bottom of that slide. Right, is that enough talking from us? Is that clear, Julia?
Yeah.
Did we have a slide with our
Yeah.
Team
So,
faces. There we go. Yeah.
mm,
So yeah, there's five of us on the
asset team.
team. So yeah,
Yeah.
I head up the team. Then we've got four development officers, um, each with kind of specific specialisms. So Julia's specialism is more on the kind of community engagement and comm side of things. If you want to nerd out about community benefit societies and governance, then Isla and Laura are your women. And then Katie, who's been on the team for a while, also has some great expertise around community engagement and comms. So, yeah, five of us and able to support with any of those models that we've talked through today. Right, that really is us.
Yeah, there really is. Okay, I'll stop
Excellent.
sharing.
Thank you ever so much, both. I found that really interesting and really useful to get a kind of sense of the different democratic finance options that are available. And I thought there was some fascinating information around the legacy giving as well, which I wasn't aware of. So yeah, so I guess now it's to everyone here, over to you for, I guess, any questions you have about anything that Julia and Morven have spoken about today, any experience of your own that you would like to share, anything that you've tried in this space that's worked, anything that you've found tricky. I guess this really is your platform now to kind of ask any burning questions or yeah, tell us your own experiences about this. I think I did a quick when people were telling us who they were and where they were from and what they were interested in the session. It was a range of people not being very familiar with democratic finance and wanting to learn more, people wanting to find out more about alternative fundraising and ownership structures and creative ways to generate income, and also about how social investment can interact with democratic finance models. And I think that was your uh, well, you're where you were coming at it from, Renee. So I'll bring you in just now. How are you doing?
Oh, good, thanks. That was really helpful. And I should say there's lots of other things that were great. Learning about just the service that you provide was fantastic. I've got a whole pile of questions here, but I'll just start with one and see whether anybody else asks the others. I guess one of the first ones I was thinking about is somebody coming to your service who's a community interest company or community limited by guarantee with an asset lock, that sort of thing. How would they go about transferring that legal structure? I know you've got, was it, I have just forgotten who was it was that does that, the governance, but I know you've got that support there, but what sort of costs are you looking at? And I guess that was one other question in that of the running costs of a community benefit society, because you're looking at sort of 3-4 grand a year for a charity for accounts and all that sort of thing. So
Yeah,
what's the comparison? Sorry,
yeah.
I've snuck two questions in.
No, that's fine. They're both linked. So just to be clear, you only need a community benefit society if you're doing the community shares or the community bonds option. So for reward-based crowdfunding, donation-based crowdfunding, legacy giving, philanthropic giving, common good funds, all the other stuff, that's a much more open model. So if we're just talking about community shares and community bonds, if you want to convert to a community benefit society, it's what's the best way of describing this? It's administratively a bit of a burden, but absolutely doable. So we've
Yeah.
done it several times now where typically it would be a company limited by guarantee more commonly, converting to a community benefit society, but a KIC can also convert. What you cannot convert a SKIO into a charitable community benefit society. A SKIO is a great model, but it's very rigid. So it's very hard to convert a SKIO into anything. So that would be a case of either shutting that SKIO down and starting again. Or what we've done sometimes is we've got what we would call a hybrid model, where you have your existing organisation and you set up a community benefit society that exists alongside it. And then any profits that this community benefit society makes gets funneled to the sort of parent charity. But that's getting a wee bit too technical, but just to highlight that there is that option.
No, that option's really useful to know.
Good.
And what about the sort of costs? Is there any support in that having
Yeah,
yeah,
so
any cost?
cost-wise, it's not that expensive. So to register a community benefit society, if you use a template, so DTAS has a couple of templates, it can be from as little as £60. Sometimes you get up into the territory of like 100, £200 if you're making some amends to that. So the actual cost of registration is fairly small. So it's more the people cost in the same way that it's the people cost anytime you set up a new community organisation, but we do handhold. Um, and then the ongoing costs. So it isn't really any different to say a ski or a company limited by guarantee. You're doing your annual return, you're doing your AGM. So again, it's people time, it's people costs, and you're keeping up with your members. The only difference is that the audit threshold for a community benefit society, a charitable community benefit society, is 250,000, whereas the audit threshold for a charitable company limited by guarantee or SKIO is what's £1 million now, I think, or that's just about to change to £1 million. So that is something to factor in because, as we know, audit costs can be quite expensive.
Yeah, absolutely. That was really helpful. Thank you. I'll let somebody else ask a question, but here when you need another.
Renee?
Hi, I've got Emma and then Gillian. Emma.
Thank you. So just to ask you, so if an organization has a hunk of money and they're wanting to invest it or grow that money, am I right in understanding that the community energy is like the most promising in terms of the potential options that they might have?
So just so I understand, Emma, so this is if you're a community organisation that already has money that wants to invest it into something to grow its money. Yeah, I would say so. I mean, I would start with what is, if you want to, well, it's two things. One is either you want to just do some investing, so sort of in traditional sense, you almost kind of invest your money to make money. And there's various options there. There's traditional investment, there's investing in other community businesses. Yes, they're investing in community energy. Or do you actually want to start a business yourself in order to grow, to increase your revenue? And in that case, it's about what's the local need, Is it that it's a local shop or take over the local pub? But yeah, if it's about what is one of the main opportunities at the moment, if you can set up your own community energy initiative, and I appreciate it's not for every geography, then yeah, there's revenue there. Or a shared ownership option where you approach a local wind farm and say, hey, can we get a slice of this? There's lots of ways you can invest money and grow it, I guess. So it's based on the kind of your own needs and your own purposes.
So basically your team can advise on that in terms of the different options available to an organization. Is that?
Yeah. We have to be super, super clear that we are not financial advisors, so we can't give investment advice. But what we can do is we can provide, guidance around what other social enterprises, community organisations have done and what the kind of the routes to investment might be.
Yeah, that's great. Thank you.
Brilliant. Thanks, Emma. Gillian, over to you.
Thank you. And sorry, I've lost the ability to raise my hand because I've not done the update. That was really fascinating. Thanks so much, Morven and Julia. And it's lovely to be in a space where it's actually sounding quite hopeful and hearing about all the practical resources and support. I just wondered, I suppose capacity has come up a few times in relation to like bigger charities still get the tranche of kind of legacy giving, but also the Action 40 example was great to hear about. I just wondered if you could speak more about the kind of infrastructure that they had, the people infrastructure that they had in advance of getting involved with yourself on the community shares, but also I suppose immediately my brain's like, oh my gosh, we've got to give 1,000 people 2% extra back in 3 years' time. Like, how on earth do you think as a small organisation do you work towards that, and what support is available for that kind of longitudinal bit? Thank you.
Thanks, Julian. First of all, loving your post-its in the background. That's making me feel very happy. Yes, capacity is the big thing, isn't it? And I mean, the general point is at DTAS, we push as much as possible for funding for staff. You know, these community organisations, social enterprises can't just run off volunteers. So that's something that's separate to this is a key focus for us. And yeah, to run a community share offer takes a lot of people power. It's quite focused, so it's not something that you have to work on for years. You know, typically a campaign might be kind of 6 months of the intensive work, but it is quite intensive. So we really stress the idea of collective responsibility and making sure it's not just one person doing the whole thing. With Action Porty, they had staff, I'm not going to lie. So, you know, they don't have many, but they do have a couple of employees that were really key to the campaign. And they have a really active board. So that's something we sense check at the beginning. We go, you know, do you have the capacity to do this? Making sure it's not just one or two people, but it's you know, at least six and ideally more. Saying that, the whole point of a community share offer, or sometimes even just a crowdfunding campaign, is to build capacity and engagement. And we know that when people put their money into something and say that even it's just purchasing one community share at £10, they are much more likely to use that business, step up to be on the board, be a volunteer, you know, whatever that role is. And there's tons and tons of evidence now that it kind of increases capacity. And then your question about the finances, yes, community shares, community bonds, this kind of repayable side of the finance options isn't for everyone. And again, we'll kind of sit down at the early stage and go, can your business model actually stomach this? You know, can you afford to pay back, even if it's small interest, 2% interest in 5 years' time? However, the kind of beauty of community shares is that the control around finances always sits with the organisation. So it's quite typical in some years, so COVID being a perfect example of this, or just any kind of bumpy year, for the organisation to go, you know what, guys, like we can't afford to pay interest this year, or we can't afford to offer withdrawals. Like the health of the enterprise like comes first. And because your investors are your members, they're your community folk, like 99% of the time they're like, thanks for letting us know, thanks for communicating that well, no problem at all. So yeah, it's a much more flexible model than saying go to your high street bank and getting, you know, standard debt.
Thanks, Morven. Yeah, I mean, I have a vague memory that there was a kind of community sen bond at one point, wasn't there? I think in Scotland, and I think I personally invested in that, and I think a few organisations did as well. And that exact same thing happened, that it was due to, I guess, mature at a certain time, and we were asked if we would continue to invest, and as far as I know, most people said yes. You know, so I think that's fairly common. If that gives you a practical sort of example, Gillian.
The communication of it, isn't it? And this idea of it's not us and them,
Yeah.
you know, you guys as the investors into that, I guess, we're the members and we're part of that organization. So, you know, you're sort of communicating to yourself, aren't you? And just making sure that it's really clear why in any one year you can't pay the money back. Then most investors, because they're invested, not just financially, but socially, are okay with that.
Cool. Thank you. Renee, hello.
No, is there nobody else? I thought somebody else. Yes, if you don't mind. The phased withdrawals is something that I was also wanting to talk about, and that exit plan. I mean, one of my first things that comes to mind is 2% is really low. And whilst that's lovely, is there sort of other people that make it more lucrative as an investment, in that actually, you know, people who want to make something off their investment will invest in it? Or does that just tend not to be community shares the way they work? That's okay if not.
Yeah, so community shares is absolutely about social return on investment over financial return on investment. Saying that, if groups can afford to offer interest, they do tend to raise more money. So it's always a balance of how high do you push it in order to attract the investment, but don't push it too high because this is about a social return. And this is actually one of the only things that the Financial Conduct Authority will take note about. So as I said, they don't regulate this space, but if they see a community benefit society offering an interest rate that's too high, so say we get into the territory of like 7, 8, 9%, they start to go, is the private gain trumping social benefit and wide community benefit in terms of the use of the money? And a really key point, I get really nerdy about this, but I think it's important, is with community shares, it's not a dividend. So this is not about distribution of profit in the way that a traditional private business would do. This is about interest on original investment. So you set the interest rate at a point that, like I said, is going to attract enough capital in the first place. So I know that's kind of a bit nuanced, but it's an important distinction about it's not distribution of profit. It's just about trying to bring money in and give an incentive, I guess, to your investors. A really interesting thing we see is that even when groups do offer interest, sometimes many of the members will say, actually, you know what, this year we don't need it, like just keep it, and then those interest payments just remain with the organization.
And sorry, this was meant, I had a few different bits on this. So that are phased, is there a full exit plan, or do you always expect to retain a certain amount of the investment? And I guess I have a second part on that of when you do have exit plans, I presume it's like a percentage of your shares that you're offered to, because if you had one person who had lots of shares, how do you sort of phase that fairly so that who gets repaid, assuming they want it? And the other one, because we were talking about the wills and legacy, is what happens if somebody passes who owns a large amount of shares? I take it those shares are still just passed down intact.
I'm loving all these dorky
Sorry.
questions, Renee. You're my kind of woman.
I've got a couple more.
Yeah. So to answer your first question, do you kind of plan to withdraw all? So it depends on the enterprise. So we tend to see with big community energy projects, for example, so when communities are using shares to finance a wind turbine, where the income is steady and it's reliable, and you can really plan that out over the 30-year lifetime of the turbine, then yes, those groups will say by the end of 30 years, we'll have repaid all of the community shares, and this is the way we're going to do it. But there's a real spectrum of approach there, down to your really marginal community shop or community pub, where it's much more about saying, our hope is after 50 years, we might repay back all of the shares. But what's much more typical is that withdrawals are financed through new members coming in, rather than the business actually having enough sort of liquidity every year to pay back the shares. So withdrawals might be offered because you've got someone saying, right, I don't want to be a member anymore. Can I get my £100 back? But then you've got another community member saying, okay, cool, I'll purchase those shares. So,
and would you aim for all the shares to lower in value that way? You sort of give the higher shareholder. Sorry, that was just a thought.
Yeah,
because so you bring in more members that way, because each share, you only have one, and that would be beneficial as a way to the trajectory.
Yeah, so shares are always the same cost. So typically it's £1 or it's £25. So people are buying multiple shares. This is where having a withdrawal policy is really important, or linked to your second question. So we would always work with a group to have a withdrawal policy that sets out things like if I've got £10,000 worth of shares and I request a withdrawal and someone's got £100 worth of shares, just because I ask first doesn't mean that I get all 10,000 back. So it's often a kind of percentage basis, a kind of pro rata, whatever the system is, just to make it fair. And organizations tend to cap the maximum amount of withdrawals that they'll offer in any 1 year as well. Typically, it's 5% of the total share capital, so not a lot. So that's all the kind of like technical detail that we'll work with to go, how do you make this fair? And crucially, how do you make sure that you're offering withdrawals in an appropriate way where you actually can afford to do so? Like it needs to be from profits or from other shareholders coming in. Like if you're making a deficit in any 1 year, you shouldn't be offering withdrawals to your shareholders. And it's all about the communication of that. And then final question, yes, on death. So we tend to, if we do a community share offer, you will fill in your application form, normally online on a digital form, and part of that will be you nominate someone on your death to receive your shares, and they can be transferred over. And that's up to a maximum of £5,000 of share capital. Anything above that gets dealt with by the kind of probate estate system. But yeah, it's very typical that someone will nominate someone to receive their shares on death.
Is there a like built-in way that you can make that go back in part of a legacy as an offering? Would that
Yeah, so
like
yes. So you could say, actually, I just want my shares to be donated back to the organization. Yeah, yeah. And we occasionally see that as well.
Sorry, I'll let somebody else go.
Also, just to say, another like layer of protection on community share offers is like, yeah, when we work with groups, we do encourage them to set like a maximum limit of investment. So for each individual investor, so even though it's like a one member, one vote system, you still don't want one person to have significant financial control of the business and buying up like 50% of the shares. So I think the limit is like 10% of the total amount.
That's really useful to know because lots of my questions. Yeah. Thank you.
I'm loving all these questions, so please keep them coming. Emma, back to you.
Thank you very much. So yeah, just a question about purchasing churches. So in terms of the most financially sustainable projects that you've seen, what has been kind of, I don't know, top 3 characteristics, say, in terms of what's really made those projects successful from a sustainability perspective? Yeah.
For church buildings specifically?
Yeah.
Very good question, Emma. So this is really new territory for DTAS. So we have just been running this program, I want to say 6 months, but don't quote me on that, but not long. And this is because of the huge rationalisation of the kind of Church of Scotland estate that I'm sure you're all aware of, the fact that there's hundreds and hundreds of churches. So I think it's safe to say that we're still on a kind of learning curve about what works and what doesn't. I think there's a couple of things. So one is ensuring that you're not just saving a building, that your drive is to create a business or fulfill a community need first and foremost, and then to save the building. And I know that our colleagues sometimes work with groups where they go, right, we really need to start this enterprise and we've decided we're going to take the church on for that purpose. And they've gone, do you need the church? Like, why can't you just do it in this other community space? So that doesn't really answer your question about church buildings, but it doesn't always have to be the church building.
But that's useful though.
Yeah. The other thing is the actual fabric of the building. So the purchase cost of some of these buildings can be very small, like remarkably small, but it's getting a really, really sensible sense check on how much it's going to cost to make it not just wind and watertight, but actually usable. And working with CARES, the organisation I mentioned, to check whether there's kind of renewable tech that can be used, which sometimes is tricky with church buildings due to the kind of listed conservation element. So that would be a key piece of kind of early stage support. And then in terms of what we see that works, I mean, we have quite a lot of development trusts that operate in church buildings where it's multifunctional. So just not just one thing, it's a cafe, it's co-working space, it's event space. There's kind of clubs that hire on a sort of regular tenanted basis. So a kind of multifunctional model. Something that's emerging that I think is quite cool is kind of leisure and sports ideas. So things like climbing centres, a skate park in a church was something I heard of last week with the team. So something where you don't need to worry too much about it being pristine and perfect. And actually, it doesn't matter if it's not boiling hot, if people are climbing or skating around, which I thought was quite cool.
Yeah, I think on that, I think the projects we've seen that really work is like Morven saying, either the church is like the only building in the community and like there's a clear need to take on that building, or the enterprising idea works within the church building. So either it's because you need the high walls in order to do a climbing center, or you're doing like a heritage project where your idea is inherently linked to having that building. Whereas if you just try to like shoehorn in a business just because you want to take on the church, I think that's where we see these projects not working as well. Yeah.
Just a
The skate was
idea.
fascinating. I sent them your way, actually. But I think there's something in that dreaming big as well. That one in particular, they want, a world-class facility that will attract competitions worldwide coming and, all the way to Scotland. So there's that kind of bigger dream and really unique offering that's important. I don't know, maybe.
Yeah. I think one thing we're seeing with churches in particular is linking into that diaspora and the kind of the wider community, and with philanthropic giving for church buildings internationally is something that our colleagues are sort of exploring and tapping into. Our models are much more about that kind of local money going into local organizations. But there are tons of people that feel connected to Scotland all over the world, and the idea of saving their local church building is attractive to many.
Great, thank you.
Good point. Okay. Does anyone else want to come in with anything? I've just got a question more out of interest than anything. When you were talking about the legacy giving and it being a sort of a longer term strategy, I just wondered, was there any increase in the here and now donations through doing a kind of legacy giving campaign with your community?
Still early days in terms of exact examples for you, but it is something that we are sort of encouraging our pilot groups to have more confidence to ask, once they start that conversation about legacy support and demonstrating their impact and why this is a good organization to invest in or leave a legacy to, then why not actually go, oh, by the way, we've also got this option to do a direct debit every month, and you could give us sort of £10 every month, and here's how to sign up. So I guess that's more in the kind of local philanthropic giving space. Yeah.
No, in terms of the groups that we've worked with, I think it's still early days, but from the examples that like Remember a Charity has, and charities who have like established legacy giving programs, I think a lot of the people that leave legacies are people that donated in their lifetime. So that's like a really clear pipeline to go from like donating to leaving a legacy as well. And it's all integrated into like the same like donations page, and like that's what we're trying to get our groups to do, is to not just ask for a legacy separately, but like think of it as part of like, this is how you can support us, this is just another way that you can support our work.
That's really interesting, thank you. Okay, Renee, I see your hand, but Brian, were you putting a real hand up, or were you just scratching your head, or I couldn't tell? Are you coming in? You're on mute if you're coming in. Brian, you're on mute. Nope. Okay. I can ask you to unmute, but I don't know.
I
don't
have
think...
unmuted.
There you go.
God.
There you go.
I'm the kind of guy you want from a legacy point of view, ladies, because I don't have that long to go, obviously. But with any luck, I might work out how to use my computer before then. Anyway, a couple of observations. Impact Hub Inverness, its parent company was the first community interest company in Scotland. So we've got loads of experience of being a kick. It's really interesting that community benefit companies are being supported, and yet you don't look on, community interest companies haven't really been looked on that way. And yet it's dead easy for us to take on shareholders. And that's exactly what community interest companies were for, was to take on shareholders and bring in capital that way. I'll just leave that out there.
I think, Brian, that's a more traditional company shareholding model, though, which works and it's fine, but the kind of idea of shareholders in a community benefit society is different from shareholders in a community interest company. So there's society law and there's company law. So just to make the distinction, they are very different.
Yeah, I would agree entirely with you. And but the big thing about the community interest company actually is that right from the word go, you definitely feel there's ownership there. And I was kind of interested in it from a community benefit company. When you have got bonds and you've got shareholders, in the accounts each year, do you treat them all as debts, short-term debts that you might have to pay back immediately?
So community bonds would be reflected as debt because it's debt, and it would depend on what the actual terms of that bond offer are. Community shares are reflected as equity in your balance sheet. They'll sit below the line. Yeah.
So there's no expectation that you're actually going to pay them back.
No. So yeah, the control that you offer and you hope and you wish and you plan, but the kind of control sits with the society.
Okay. I kind of like being a part of a community interest company because of that drive. Twice we have borrowed, and I would encourage community businesses also to borrow. We borrowed from the bank, and despite what people say about the bank, they made us an offer within 24 hours of us applying to buy a building. And since that, in my community association connection in Allness, again, we have gone to a borrower to actually borrow money. And the great thing about borrowing money and knowing that you have to repay it every month is it really makes a difference to what you put into your cash. Your cash flow projection has to really satisfy yourself. And that's what I would say to our previous questioner who had come on. If you are wondering about being able to pay 2%, you really have to ask yourself if you should be doing it at all. Because every time that I've been in any of these things, we have been in no doubt whatsoever that we'd be able to repay. And if you don't think you're going to be able to repay 2%, then I'd walk away from it personally. Yeah.
I couldn't agree more. You have to take the type of finance and funding that suits your business model, and that's so crucial, or you'll end up in a lot of pain.
Yeah, absolutely.
And to be clear, we're not involved.
I didn't catch that.
Sorry, especially if there's interest involved. It's that debt accruing when things go badly is crippling.
You're so young.
I wanted I think, like Brian, the reason we've got this sort of model is because you can't have kicks, it's very rare to get kicks limited by shares in Scotland.
It's becoming more and more common.
It is.
It's common, but it cuts you out from quite a lot of traditional grant funding in the community sector.
Yes.
We've never applied for it.
We've
never applied for a grant. But every time that we've decided to do something, we've come up with a business plan to justify it on business, for business reasons. And I kind of like that.
Yeah, absolutely. There's a lot of reasons, I work as a social investment relationship manager. There's a lot of reasons for investment and social investment, and there's some great deals out there as well. First Port step up loan, no interest, no fees. That's, don't get much better than that out there. But just a small plug. But I actually did have some things. I'm sorry, I've got more. The legacy stuff. I was wondering, Jayne, you stole my question about something up front. Is there some sort of legacy program that you can run so that when people leave it in their will and make a donation up front, they can become like legacy members, or has that been tried?
Yeah, for our groups, we're still very like early stage. That's not been developed, but a lot of the charities that have established legacy programs, yeah, they'll have like think of what they call a legacy circle. So it's like people that have left gifts or have pledged to leave gifts in their wills and are also donors in their lifetime. They'll have like a supporter circle. They might have like events programs that revolve around sort of this legacy giving campaign that happen annually. But yeah, I think you have to be at quite a like mature stage in order to do that. And you have to have like quite a few like supporters who have already pledged or have already left a gift in your will in order to be able to build that program.
Yeah. Yeah. I mean, it makes a lot of sense. It's going to take a certain amount of people power to do. Yeah. And I guess the other thing I was wondering about, I'm pretty sure this is actually my last one, I promise. Is is there any sort of thoughts on trying to get recipients of inheritance sort of, rather than waiting until, so it's very grim, I know, waiting until somebody passes, the people our age plus whose parents are, passing, and sort of that happening now feels like it would be a kind of more, for them to make that decision as well, as a target, but equally you're, targeting bereaved people. But it just occurs to me that there's another point at where people are receiving that legacy of their own, and they might wish to, I don't know.
It's something we've definitely talked about as a team, but it feels like potentially kind of phase two of the project of, how would you target those people in your community and how you would do it sensitively. I mean, that's the beauty of a community organization, right? We don't do this work for them. They're the ones that know their community and know who those people might be and how they might talk to them and if it's appropriate to talk to them. So it's more about us giving them the kind of the tools and the resources and the technical support needed, but they're the ones that actually have those sensitive conversations.
Yeah, and I think we've had cases in our church's program where people who have received inheritance have come to the community organization and donated. But yeah, that's been very like they have been the active person. I don't think we've worked yet with a group where the community organization reaches out like proactively to someone who's an inheritance. So yeah, I think there's like a sensitivity there.
Well, I was just thinking that sort of, classic, you buy a bench and put the names on, and, I know I am somebody who has lost a parent fairly recently, but so I'm not totally blind to the insensitivity of this, but buying a bench, if you thought about how to do that in a more kind of proactive way but wasn't quite as money grabbing. I don't know what I'm trying to say, but you can imagine what I mean if you had a sort of legacy bequeathing or
I think you are being sensitive, because I think it's not just about the money, it's about that community member going, how would my person want to be celebrated and remembered? And if they know that they've had a lifelong connection to that community organization or that development trust, whatever it might be, making it easy for them to then go, okay, this is how we do that, this is how we celebrate them. Makes a lot of sense to me. It's just finding the right sensitive roots in, isn't it?
Yes.
Yeah.
Don't be too sensitive.
Go on, Brian.
Don't be too sensitive. honestly, don't be too sensitive. I'm of that generation we've come through all sorts of difficulties in life, and we've come out the other side. And lots of us have got stacks of money that we did not expect to have. Don't have any qualms about going up to them and asking for the money. Don't think twice about getting them to sign up on a direct debit and giving you money every month. 90% of them, okay, will say no. All you got to do is make sure that you ask 100% of them, because some of them will come forward. I'm in a group with another bunch of people who, on a voluntary basis, have been putting a small amount of money away every month. We've done it through Lend with Care. We now have put £100,000 through the Lend with Care organisation. It's not large sums of money, and all you actually have to do is ask people. So come up with magical ways of talking to folk and just ask.
Brian, you may find us really popular after this session with this
But I'm the guy who borrows money for our social enterprises. No,
that's true.
I know, I'm just having an idea if you could have an amazing benefit concert in your church or something.
You could do all sorts of things.
Yeah.
But you have to be enthusiastic about it, and you have to be practical about it. But you can do it.
Oh,
most things are possible, I think.
Yeah. I just realised I did have one more question. I'm so sorry. Does anybody else have any questions? It'll take some time.
One more question, Renee.
All right.
And then we'll
I'm sorry, you were going to get time back.
People a bit of time back.
And then I turned up. My last question was about communities of interest. So I know most of it's really locality based, but do you have any examples of, I'm thinking about the skateboarding community interest company, for example. Skateboarding is their community of interest, and it's going to be much more broad than even if, in Edinburgh where their skate park is. Have you got any experience with that? And is that something you would work with?
I mean, most of our communities are both communities of interest and communities of geography, if I'm thinking about it. So, a pub, a shop, a food growing program, it is both. It's very much people that are interested in, how do you set up a community shop? How do you run that? So yeah, it's both. Where we wouldn't support is if it's a community of interest that isn't rooted in place, so has a much more kind of national approach or a regional approach where they can't demonstrate that they've got local community benefit. But yeah, most are both, I would say.
There's a really interesting article that Linda Gillespie from COS, so one of your colleagues, has written for TFN recently about defining community. I'll pop that in the email that I send out after the session. But I thought that was really good. It's not related to democratic finance specifically, but it's around your question in a way, Renee. Okie doke. So I hope this has been really helpful for people. I mean, I certainly know I've learned a lot. I hope you have too. I have loved the nerdy questions, thumbs up, but all of those. But these are the important details that it's really important that people are aware of before they, kind of start going too far down a track that maybe isn't so relevant to them. So I, just want to say thank you very much to Julia and to Morven for sharing their time and their expertise with us. The presentation and email addresses and a few other bits and bobs will come out to you hopefully later this afternoon. Thank you all for coming along. Thank you all for your questions. I love it when we've got people that are engaged and questioning and curious. I think that kind of helps everyone, because somebody else will be thinking of a question that that you're asking. So yeah, thank you to everyone. I've popped the evaluation survey into the chat. Honestly, a minute it will take you, and it's really helpful for us. We'd be really grateful. So 7 minutes back from you in your day. So use it wisely. And thank you all again. Thanks to our speakers, and see you all soon.
Thanks so much, Jayne.
Thank you very much.
Thanks.